You guys might have heard that the big news in the financial and investment world is that Missouri is the first state in the union to eliminate capital gains tax. Moving to southern Missouri is the best thing I've ever done for my family. And this is particularly exciting in real estate because as sellers, we all know that at times we have to pay a considerable amount of money to both federal and state taxes for capital gains when selling real estate. But let's back it up a little bit. Let's look at all the aspects of this bill and see the different areas that it will affect. So first I want to say it is being pretty heavily debated and discussed right now of what does this mean in terms of loss of revenue for Missouri? Now, of course, Missouri House and Senate Democrats had something different to say, and they also believed that the amount of revenue that would be lost was much, much higher in their estimates.
Fundamentally, we're talking about $1 billion. We're talking about $1 billion going towards our schools, our roads. We are the show me state for a reason. We learn from the mistakes of others.
This is textbook trickle-down economics. We are hearing the case from the other side that tax cuts on rich people will help us all, and we know for a fact that is not the case.
This is the people's money, and I feel that deeply.
We do spend the people's money, and we should be spending it on the people.
The benefits of the Missouri proposal would go to the richest people in the state. In a time of uncertainty, cuts in federal funding, we're doing this.
I've been noticing like the most frequently cited number around 350 million. But I'm seeing a very wide range. Most people are saying somewhere between 150 and $600 million in revenue will be lost. That's the negative way to state it. Or you could say that 150 to 600 million will be saved by Missourians, right? So it depends on how you look at that. And potentially a little less discussed aspect of this bill is how it will apply to corporations. So, like the individual income tax, there's not going to be restrictions on whether they're short or long-term capital gains. So, short-term, of course, being anything under a year or under, and then long-term being any asset held longer than a year. But where this gets interesting and where I think we're going to see some really creative tax strategies by corporations is the way that they're designing it for corporations is that they're calling it a trigger mechanism. So when you have the corporate income tax is going to be like low level. So it's going to be like 4.5% and under. So when they fall into that income tax bracket, then the following year, that corporation can actually completely eliminate their capital gains and not pay the following year. Now, I am not a CPA, but I am just assuming that we're going to see a lot of tax strategies where corporations really limit their taxable events one year, maintaining that 4.5% bracket, and then really enjoying and maximizing the next year where they will have absolutely no capital gains. And that would be the year to do all your tax events, your taxable events. So I am sure we're gonna see some just brilliant, creative ways to use this new bill. There's some other stuff. Some of it's important. Some of it kind of seems like fluff, like no taxes on they call them feminine hygiene products, right? Hey, no taxes on diapers, which I've got a baby, so that's awesome. But that was probably just a crowd pleaser. You always got to throw some of those into these bills. There was expanded tax relief for disabled residents and for seniors, and I do always support that. I think that although I'm not a real big proponent of taxes in general, I certainly don't like a huge welfare state. I do think that we need to have a safety net. So I'm kind of like, somewhere in the conservative middle of that. But really the bulk of this bill, the real heart of this bill, was eliminating capital gains tax for individuals and then partially eliminating it for corporations. And like I said before, that's going to be both long-term and short-term capital gains. And so it's going to be for stocks, real estate, and an assortment of other assets. In fact, I am sure just the wheels in people's minds are churning right now, because there's so many creative ways that you can use entities and like moving around and kind of manipulating your taxable events through different entities. So I am sure so many people are just thinking very creatively and very much out of the box right now. And it will be interesting to see how this new law is used. And I think it's fair to say that this is just yet another positive aspect that's going to make Missouri more attractive to high net, not just investors, but residents looking to move to more favorable states. I mean, it's definitely considerable. And at the end of the video, I'm going to do a little scenario so that we can kind of see what savings someone like me or you would have when selling a home in Missouri. So I can't totally dig into the details because I'm still in research mode, but there's a lot of really interesting conversations about how this is going to affect retirement accounts, ones that particularly have dividends and distributions that were taxable within Missouri. A lot of talk about trusts, which I thought is super interesting. Trusts can buffer a lot of different tax events, but obviously can, hold assets that have capital gains, right? And I would say that Missouri is known for already having very strong and appealing trust laws in this state. And so one could argue that it is even more desirable to move and operate your trusts in Missouri now that capital gains are protected from taxation. So there are also a lot of really interesting conversations about opportunity zones in real estate, where that is a way to pretty much develop in low-income areas or areas that municipalities want to see expanded, although I think they're federally designated. I'm not even sure how the opportunity zones are figured out, because sometimes they're like not even the worst of the worst areas, or they've kind of started going through gentrification. But there's obviously huge tax incentives there. So there's a lot of theories that we are going to see less incentivization to do those opportunity zones. And then also 1031 exchange. I actually looked for and have not found a super intelligent discussion with people way smarter than me, because I am not a financial advisor. Yeah. Not even close. I just understand rudimentary, very rudimentary, elementary level of financial topics, but it's so fascinating to me. And I started thinking about 1031 exchange and being I need someone to describe why we would do it now. Why would we need to defer that tax? Now, I'm going to assume that people are still going to do it for, of course, federal income tax, capital gains on federal income tax. So yeah, but it would be really interesting to have it put through a lens at the state level, and is there even a reason to do that at the state level? So that is all incredibly interesting to me. It's going to be really interesting to see how people's strategies change, where in the past, a lot of capital gains have been slowed down to where you're not realizing all of the gains at one time, trying to not trigger the same taxable events. And it's just going to be interesting to see, at least on a state level, at least on some level, if that doesn't really change some people's financial strategies. And this is another interesting point, is that a lot of investors will actually use different kinds of charity and donations to minimize those taxable events, right? And we see a lot of investors who actually will donate appreciated assets at the end of the year to prevent that having to pay in taxes as a gain. And it'll be interesting to see how this changes donations and charity in terms of when people are using it really as a tax strategy. So like I was saying, I wanted to go through a scenario for like the average day person, me and you, what it looks like as a seller to not have to pay capital gains when we're selling our properties now. So let's say in this scenario that you have a $250,000 property that you bought years ago, and you are now going to sell it. Let's say you bought it 5 years ago actually, and now you're going to sell it for $500,000, right? And so what would you have paid on that $250,000 that is your capital gain? What would you have paid prior to this new law? So before I get into the numbers, it's important to remember that previously in Missouri, all capital gains, whether short or long term, were taxed as regular income. And so that tax, roughly 4.7%, would have been taxed on that $250,000. So previous to this law, you and I would have paid $11,750 to the state of Missouri when we sold that property with a $250,000 gain. So in my world, that's a good chunk of money. I'll take that. So I would say this does incentivize sellers to sell and to get to capture those gains. Now remember, this doesn't mean that there won't be still federal income tax, but in this scenario, for example, you still wouldn't be paying a federal income tax. Remember that if it is a long-term gain, right, so anything over a year, you are allowed to, when selling a primary residence, as an individual, you can keep $250,000, not taxable, and then as a married couple, you can keep $500,000, not taxable. So actually, in this scenario, you wouldn't have even paid the federal government. You would have only paid the state of Missouri $11,750, which is a nice check. And now with this bill, you will get to keep that money. So I do want to push back a little bit on what House and Senate Democrats are saying, which is that this bill is only for the fat cats. And I think they were citing that, 65% of all capital gains is just like the 0.5%. It's people who make $500,000 a year and above, right? And that's true, but I want to push back on that. So yeah, so the most money with this bill is going to be saved and realized with the wealthiest people. I mean, isn't that kind of always about everything? Like they have the most money, so they'll always have the most, right? That doesn't bother me. What I think is positive is that people like me and you get to pocket the $11,750 when we sell our primary residence, and to me, that is significant. And if you are someone like us where, you kind of move a lot and stuff, I mean, that adds up in 5 years. I mean, heck, that could be like $30,000, if you move a lot. So I think that it is positive. I do think that if we're really concerned about our state budget, we need to tighten the belt. Like we need to audit our budget. We need to audit the government. And we need to tighten the belt, and we need to make a lot of cuts. And we need to keep just what's important, and we only need to have welfare type programs for those that really need support, and everyone else needs to take care of themselves. Okay guys, we're gonna wrap up this video, and of course I just wanna say again that this bill is just another reason that Missouri is a great place to live, invest, buy property, sell property, and enjoy you some capital gains. As always, you guys, all my information is in the description. However you like to communicate, call me, text me, email, we can set up a Zoom, whatever you guys like, and I can help you make the next best move of your life. Until next time, bye.